You got to remember, this owner created something special. It wasn't just one person. There's a lot of reasons why you're buying this company. It's not just in the owner. It's the people around it's the secret sauce.
On this week's episode, we welcome to the tank Mario Nigro, a seasoned partner at Stikeman Elliott, to discuss navigating the world of search funds and the recent trends in mid-cap M&A. Mario shares his journey in becoming an M&A expert and discusses the evolving landscape of mergers and acquisitions, particularly in the Canadian context. We get Mario to explain the recent rise in popularity of entrepreneurship-through-acquisition model and the essential traits for wannabe search fund founders. We discuss the current trends in mid-market M&A and the impact of rising interest rates and the biggest changes since the 2021-2022 market correction. Mario also shares some practical tips for sellers when preparing for M&A and the importance of strategic planning and cultural due diligence for buyers. Lastly, Mario provides his outlook on the future of mid-market M&A and the role of technology and the opportunities available for younger entrepreneurs. Now let's jump into the tank for this week's episode with Mario Nigro. Thanks for joining us in the tank today, Mario.
My pleasure, man. It's a pleasure to be here.
Great to have another podcast host on the show today. You know, obviously, a lot of people in the M&A space know you pretty well as the godfather of a lot of the search fund industries in Canada. But for our audience who may not know about you, tell us a little bit about your journey to becoming a partner and an M&A expert, and where you spend most of your time as a professional.
Matt, you are too kind. Calling me the Godfather is very kind of you. And I want you to know, given that I'm Italian, it has a special meaning to use those phrases. So, you know, you can call me the Godfather anytime for anything.
Let's go.
So actually, believe it or not, I started off as a teacher, kindergarten teacher. I know that sounds crazy. I wanted to be a professor, so I have a master's degree in sociology, so you could see the real direct connection with search funds. No, I'm kidding. And I ended up going to law school, never thinking that I would be doing private equity or any of the stuff I'm doing now. That was not the original path. But as I started my life as a lawyer, really came to enjoy business law in the fact of just helping get deals done and helping people build something. In my early years of my practice, I started to get into this thing called private equity, and particularly U.S. private equity, U.S. mid-market private equity that was really coming into our marketplace. What happened was I really spent time building out my relationships with U.S. private equity firms. And people in the marketplace started to say, hey, wait a minute, you got all these relationships with private equity firms. It's very hard to raise capital in our marketplace to do deals. People would say, any chance, I want to try to do a deal. I need money. You got all these connections to people who have capital. You think you could put us together. Now, I'd love to tell you, Matt, it would be my dream to tell you this is a strategic, big vision moment in my career where I saw what was going to guide it. You know, at the time, I remember people were just trying to find money to do deals. And our marketplaces doesn't have the same entrepreneurial capital that the U.S. has. And because I had connections to the USP funds, I would link them. I would say, listen, why don't you go call here, introduce you to some of my USP contacts and sources of capital from the US. And lo and behold, it became a bit of a virtuous circle. People said, well, thank you for introducing me to capital. And of course, my US clients said, thank you for introducing me to deal flow. And then that's how I first met the search funds, which honestly, when I met them, we used to call them one fund deals, pledge funds or independent. We didn't use the word search fund. I didn't even know what a search fund was, but I could see where it was going in the sense that, you got smart, motivated people who want to build and grow a company and then, obviously have a successful exit. Well, guess what? That's the story of private equity. That's what KKR did. That's what Carlyle did. Pass the hat, grow the company, sell it for 10x and do it again and again and again. And I saw that in the search funds. I saw the opportunity of, talented people who wanted to do deals. And you know what? They don't stop at one. And so I started to make an investment in the space, an investment in them personally. And that's, probably what I do is just spend a lot of time supporting them when no one else will. So I usually talk to searchers from day one, help them to write their PPMs, help them to find capital, help them to find deals, do their legals, put some money into these deals. So I'm kind of like try to be a bit of a hub for them because we don't have a lot of institutional support for this space in Canada. Now, that all being said, the space is starting to grow exponentially. People are really being attracted to the space as an alternative to really do private equity without committed capital or if you don't have sources of capital and you want to try to get a deal done, this has become the way to do it. The nice part is the marketplace is now, sees search funds as legitimate buyers. And so they're probably, I would say, the most recognized players in the lower middle market. The 1 to 3, 1 to 4 million EBITDA. If you're looking to sell a company in that range, search funds are probably, from a deal perspective, the most prolific buyers.
Yeah, especially in these markets. I know, Mario, you're taking your psychiatry background or psychologist background and applying it with your legal background to be basically a deal psychologist. But for our listeners who may not really understanding when you say the word search fund, even though it's come into vogue recently, can you explain what that actually means and also describe the difference between self-funded searches and then sponsor-funded searches?
So, we're going to go back to this. The search fund concept started in the 1980s, and it started with the idea of, back then it was talented MBA students who didn't want to go the traditional path of, let's say, being investment banking or, working in a corporation. Instead, you'll hear the words entrepreneurship through acquisition. Instead, they wanted to focus on buying a company. And so what they did was they started to raise small amounts of capital, to give you a flavor of it, it's like 50 grand over 12 or 15 investors. And it was either single or a dual, would go and raise $500,000-$600,000 to pay themselves a paycheck to go and search for a deal. And that's where the word comes from. You were given, this is the traditional search fund. The reason why we call it traditional is because in its first iteration, when it started, it was the idea that you would raise money from 12 or 15 investors who would support you at the initial phase, the search phase, to go out and find a deal. And you had a support network, and they would help you as you would to find a deal. Now, what makes search interesting, then you would find the deal. Another unique element of search, unlike traditional private equity, where then you'd put a CEO in place. In the search fund space, when you found the deal, you were the CEO, because that was the idea. They were out of MBA programs. It was a different path forward, a chance to, find a company, buy a company, be the CEO, grow, learn, and then obviously have a successful exit. So when it started in the U.S., of course, the focus back then really was supported, bright, talented, and tended to be MBA students. Now, the space became much more institutionalized in the U.S. And what I mean by that was, you'd have MBA programs teaching courses by investors who then, of course, use the ability to teach a course to find young, talented people who wanted to do this. And so that's why the space has going to grow exponentially. In the U.S., the search fund space is associated with kind of top MBA programs. What then started to happen was, as the space evolved, is you start to get this concept of the self-funded search. And the self-funded search, as you could probably guess, is people are working in private equity. People are working in investment banking. They say to themselves, I want to buy a company. You could go and try to, create a fund. But another way to do it is maybe I'll just find the capital for a deal, for a one fund deal. And so those people were called self-funded searchers. They didn't go and raise money to go look for a deal. They would pay their own way till they found a deal, and then they would go raise the capital to do the deal. And the self-funded space has grown exponentially. And you could see why grown even more than the traditional search fund space, because in the self-funded space, you don't have any barriers to entry. You just go out and find a deal. And if you could self-support yourself while you go look for a deal, you basically stay out there until you find a deal.
Now, let's explain the economics, though, so people understand the difference, the reason why an investor gives money for a funded search versus obviously the economics on a self-funded search. Can you explain the difference in those and how it works for the investors?
And let me give you, before we go there, just a quick, so that's the kind of, that's the general framework of the self-funded search and the traditional search. But let's talk about Canada, just to overlay Canada. What's happened in Canada, uniquely different from the U.S., is most searchers are older. So in the U.S. model, most searchers come out of MBA programs. 90% of searchers come out of top tier MBA schools because, again, it's like almost an institutional path, right? You get to an MBA program, you take what's called an ETA, entrepreneurship through acquisition course. You meet a professor who's actually an investor who encourages you to do this, and you have a path forward to actually get a search fund. In Canada, we didn't have that. What has started to happen in Canada, and this is how I got involved in the space, these folks came back from the States who had done these courses and said, I want to do this. How do I do it? We don't really have capital sources. We don't really have the entrepreneurial capital that they're used to in the States. They ended up being people who were older, had more years of experience, had more years of service. So in Canada, we have the traditional search fund space, but what we have more of in Canada is self-funded has exploded in terms of its growth. And that's because, unlike the US, we don't have a lot of funds that fund search funds at the initial phase. And so just to give you a layer, in Canada, unlike the US, where it's younger people out of MBA program, in Canada it tends to be older as in more experience, more years of service, just had, let's say, another career before they got into it. And it tends to be more self-funded because we just don't have as many funds. And then when it comes to economics, the traditional search fund model has a very fixed economics for searchers. And so if you're a single searcher, you'll get 25% carry. And if you're a dual searcher, you'll get 30%. And you say, okay, well, Mario, what does that mean? So let's take what we would call the waterfall. Let's say, when we look at the money that was put in and the money that comes out. So the waterfall representing money that comes out. In these deals, how does it work? Capital contributions, the money that investors puts in comes out first on any distribution. Then there's a pref, 7 or 8%. Then there's a catch-up where the searcher gets their portion, their 25% portion of the pref. And then they split 75-25 with the investors. But the 25 is not an automatic 25. They get a third of it divests at closing. A third of it divests over time, 48 months. The reason for that is because they're expected to be the CEO of the investment. And so they have traditional search fund model. It's a requirement that you're the CEO. If you're not the CEO, you don't get the same economics. You lose economics. That's why think of it as being a third. So 8 1/3 at closing, 8 1/3 based over 48 months. And then your last part of your carry, 8 1/3, is based on an IRR of 20 to 35%. That's a fixed model. So I try to tell you that quickly. What's most important to understand is you can't change that model. A traditional searcher has to accept that.
Now, Mario, the people, though, that give money to the funded search, they, correct me if I'm wrong, get to roll those dollars into an acquisition at a discount, correct?
So if you collected money on those terms and you find a deal, what the investors get is 3 preferences. Obviously, they get a say in the deal because, you're going to go to them and say, do you want to do the deal? So they get a first look. If they don't want the deal, they would get 1.5 times their initial, let's say, $50,000 they put in. So they get a nice lift for being early capital. If they want to do the deal, they get the 1.5 times, plus they get their pro rata share of the equity of the deal. And so that's the advantage of the traditional search fund is you get a fixed commitment of equity because people don't put the 50 to invest 50. They put the 50 because you're going to go find a deal that they can put in $500,000, $1 million, $2 million.
In an EBITDA positive business that they can judge, as a due diligence.
Exactly. They can evaluate and decide. Now, the self-funded is different, right? In the self-funded, they go find a deal and then they talk to investors. And what they, usually do is depending on the nature of the deal, the size, and keep in mind, self-funded tends to be smaller deals. But what they'll do then, depending on the nature of they'll decide their economics, which tend to be usually a little bit better than traditional search funds. So traditional search fund is 25 or 30% carry. Self-funded could be 30, 35, 40% carry. So it tends to be higher, and it tends to be less focused on time-based vesting. It tends to be more a certain portion of it that vests at closing, a certain portion of it that's tied to an IRR multiple. So yes, self-funded does lead to usually better economics. Obviously, there is no 1.5 step up, or you decide the investors, you decide who you want on your cap table. But depending on the size or the character of the deal, you now have to negotiate your terms in terms of the carry that you get.
And you also have to carry the risk of funding the search. So people may be asking the question, well, what is the risk of just doing the self-funded approach? Well, you have to fund your lifestyle. You have to fund your legal costs, your due diligence costs, all those things. However, if you do the funded search model, they bear the cost associated with funding the salary, funding the due diligence. And the risk is after 18, 24 months, you may not have anything to show for it.
And you said the real risk on the self-funded is the time element of it. Time is expensive, right? Because if you're paying for yourself, if the deal only took a month or two to find and to close, the risk factor would be low. But as to your point out, most searchers take between 12 and 18 months to do a deal. It's expensive to kind of find the resources to be able to sustain yourself for sometimes a year to 2 years. I've worked with self-funded searchers that are sometimes searching for 2.5 years. So to your point, Matt, if you're really gonna do this, you really got to be all in. If you're just like, I only got 3 months of money to kind of sustain myself before I need a paycheck, it's just too hard. It's too hard to do. I never see people join the space and say, oh, look at this. In a few weeks, I signed an LOI. It just doesn't work that way.
Well, let's talk about those people, Mario, because obviously there takes a certain kind of person that wants to do the entrepreneurship through acquisition approach. Obviously, much more risk accepting person on the self-funded side. But from your experience over all the years that you've been working with a lot of these search fund and acquirers, what are some of the key traits you've noticed in the most successful ones as soon as they start with the shotgun going off day one?
People who do this really do have an all-in mentality. And I really mean all in. You will see that people who fund this space really look for the all-in mentality. Man, so, that's, sounds like code words, but you could see the all-in mentality. There are people who call me and say, Mario, I will not stop doing this till I find a deal. And of course, I'll say, well, what do you mean? How long will you go? They're like, I will go for what this is what I've always wanted to do. Versus people who say, well, I will do this only for 6 months because that's all I can afford. Like that is a tough haul, and it's hard to believe that you really can sustain the ups and downs of the space if you don't have an all, you know what I mean by an all-in mentality. I will see, it's pretty common trait to say, nothing's stopping me from doing this. One way or another, I'm going to do this. Sometimes I've worked with people taking 5 years to find a deal. They literally will do everything humanly possible. I'm not over-exaggerating, but when you get down this road, there's so many variables you can't control that if you have an idea that, this is my next 6 months or my next 12, it just doesn't work.
No, Mario, when I met one of my LPs in the very beginning of my fund one, they asked me for my personal financial runway of how long I could fund starting a venture fund for. And they said, if you don't have enough to last you at least 4 to 5 years, you're not going to make it.
So that's one of the things. The other thing is, and as the space grows, this is one of the tensions in the space, right? People have seen the space grow. Why are people interested in the space? Because we've had great exits, right? The results have been strong. The return profile in the space has been kind of 3.5 to 5.5 times, which reflects the return profile in the US, which has a lot more data, right? But last year, we had 6 or 7 exits in this space, of which were all amazing at 3.5, 4, 4.5, 8, 6, 6.5. In other words, the space is delivery. So of course, what happens? People go, well, this is another path for me. And then, wait a minute, but it's not for everybody. What profile do you bring, right? So more and more, I'm seeing new people come to the space. And the problem is that at the end of the day, this is a business. And you got to have those fundamental business skills, right? Like I know my own weaknesses, right? I'm a lawyer. I didn't go to business school. So when it comes to, for example, modeling or deconstructing a balance sheet, I can't do it. I know I can't. I think I can because I've done enough of it over the years, seeing it in my practice. But I know what I don't know. You know what I mean? Whereas I find people come to the space thinking that, I could figure this out. I can do it. And it's tough for them when you realize that they don't know how to model. They don't know how to deconstruct the balance sheet. Just because you were an operations senior executive, it doesn't necessarily mean you could do it, And so that kind of moment of reflection to say, do I really have the skill set to do this? It's hard, right? Like it is a tough moment. I don't want to take people away from chasing their dreams. And so it's always a tough tension to see, more and more we're getting people come to the space and it's hard. You can see that the kind of skill set they have isn't necessarily the best skill set to succeed. And often what I'll try to say to them is maybe go work in a certain environment before you do this. Of course, people are motivated to say, no, I could do this. I know I can. And, people will always look at their experience and frame it in a way that seems to fit. But if you can't deconstruct the balance sheet, if you can't do modeling, like if you've never done activities that are similar to this before, it's really hard. This is not a space where you can learn on the job. You have to have had some experience doing this stuff in order to do it right. Like it's just, people think you can't, I'll figure it out. As you know, Matt, you can't figure out modeling on the spot. It doesn't work that way. You got to know how to do it. It's a skill set,
A lot of people that have come to either ask for funding from myself for searches, or people have come to you to ask for advice. And I always say the same thing to them. I said, first, go talk to these 5 people that have done it before and ask them what they felt like on the day they closed the acquisition. First, actually, to the time they locked in an LOI, then ask them what they felt like on the day they closed, and then what they felt like 6 months into operating the business. and see how much gray hair they created for themselves after every step of the way during that process, and then see if you still want to do it.
Well said.
Talking about market trends and observations, Mario, obviously, as you said, there's been a lot of results driven from this sector. There's been a lot more funding coming into it. And the climate around businesses that are run by retirees or soon to be retirees is just exploding. And they are still looking for buyers because there's no one to buy these assets. So what sort of trends are you seeing currently in the market that have really generated a ton of interest from the investor side and the wannabe operator side?
Again, we talked about the exits. So the exits speak well to the space. They make people comfortable that it's worth the risk of, spending the time and the effort to do something like this. But then the space itself has changed. It's become more professionalized. And what I mean is, if you look at our marketplace in Canada, we have very few private equity funds in the real middle market and lower middle market. Very, very few. And because of that, a lot of the buyers that, in the US, you see, really active in the middle market, they don't exist in Canada. And even of the private equity firms we have, and they call themselves middle market, they've gone upstream. They're doing deals of 10 million a bit, or 15 or 20. They used to be doing deals of 2 or 3, but they don't do them anymore. No way, right? And so what's happened is you get these kind of lower middle market companies, the 1 to 2, 3, 4 million EBITDA. And there really is a lack of buyers for them. And so, okay, now we have, to your point, this whole succession tsunami that people talk about. We have, and frankly, remember in Canada, 80% of the business in our marketplace are 1 to 4. That's where they mostly live. So we got tons of companies. We got a bunch of them that are going to sell because of a, generational change. And where's the buyers? Well, it's not private equity. A lot of strategics won't buy them because they're too small. They can't be bothered. Well, guess what? Creates an opportunity for a new set of buyers. And guess who stepped into that void? Well, search funds have stepped into it. The ideal opportunity for a search fund buyer is to enter a process for a 1, 2, 3 million EBITDA business where there are no strategics because they're not interested, they're too small. There are no private equity firms because they're too small for them. Well, guess what? Now we're seeing the beginning of an evolution in the lower middle market where you're having these real buyers who are search funds who are engaging in these processes and creating competitive tension for these sell-side mandates in the lower middle market. And here's the best part of it. So we have sellers, companies that want to sell, good companies, lots of them. We got searchers, people who want to buy. The searcher goes to the bank. To give credit to the Canadian banks in this space, they want to lend, and they lend well on, frankly, pretty aggressive terms when you consider it's only a 2 or 3 million EBITDA business. And then the last piece, which people have to remember, in Canada, search funds have been successful historically because of American capital. We didn't have the entrepreneurial capital to do these deals. For the longest time in Canada, capital for this space came almost 80, 90% from the US. It's starting to change. We're now starting to have funds that are created in Canada to fund search funds. There's probably about 10 of them out there now, with 1 or 2 coming online every year. But on top of it, we're starting to have entrepreneurial capital, which historically in Canada used to be focused on real estate, or it didn't really come to the space. And now we're starting to see venture funds shift over to this space. And I get entrepreneurial capital. People call me and say, Mark, I want to put money in this space. Keep me in mind. I want to see deal flow. So you could see the dynamic starting to play in favor of the space, which is got lots of companies for sale, banks willing to lend, lots of searchers are interested in buying and have banks who are willing to lend, and then the capital that supports them. And that's where we're at right now. The exponential growth of the space has been because all the market players are coming to the table, engaged and wanting to do more of this. And it's exciting. Like it is, when you could see someone come to the table and, look at buying a 3 million EBITDA business and raise $7-8 million. I mean, I'll be honest with you, man, like I've been doing this for a while. 10, 15 years ago, you would never in our marketplace be able to raise that money in Canada. You'd have to go to the US, and that was the only way to do it. More and more, we're starting to see people who can raise capital in Canada. By the way, still the Americans are the core investors of the space. But we're starting to see more Canadian investors. They're starting to make up a bigger portion of the cap table. I think if this continues, that's where we're going to go. We're going to see what I would say search funds whose cap tables are made up with a majority of Canadian investors as opposed to American investors.
Right. The rise of the search fund to fund model in Canada is something that's definitely an interesting trend, where they fund the initial search with obviously a sort of scout investment, but then they have their pro rata or super pro rata to really double, triple down on the asset when they do lock in on it. And then they can start rolling in, debt and then a roll up strategy where they can put more equity to work as well. And so you can see how that deal flow kind of snowballs on top of each other once you find the first asset, right?
People say, well, like, Mara, where is the opportunity lie? Well, if you look at the kind of structure of a deal, you take a $2 million EBITDA business, you buy it for 5 times, it's $10 million purchase price. If the bank's willing to give you 6, 2 times 3, banks are giving 2.5, 3 times EBITDA. And then you're going to, in these type of deals, you don't really pay all cash on closing. The vendor will take a promissory note or maybe roll over or maybe a bit of an earnout. So 20, 25%. If I told you could buy a $2 million EBITDA business with good cash flow, it's been around a long time, that's stable, that's secure, and pay only $1.5 million or $2 million of equity, you see what the opportunity is, Matt? It really starts to become, and to your point, wait a minute, if I only need $1.5 million or $2 million, I mean, you could see, well, what's fantastic. Now I could buy a real business for only $2 million of equity that's got legs. And then, of course, I can start thinking about what to do with it in the future because I only used $2 million of equity. Like, I didn't use a lot of equity. And so that the opportunity in this space of why it's ideal is you could buy these $2 million EBITDA businesses or $3 million EBITDA businesses for reasonable multiples, not cheap, reasonable, right? Search funds are real buyers. They pay real multiples, but they're not paying crazy. And they're also not paying like book value. They're paying real. But if they can buy them at a reasonable multiple, and to your point, you could build a strategy to grow them, and it doesn't take a lot of equity. Well, guess what? Then you get them to 6 or 7 or 5 or 6, 7 million EBITDA and sell them to private equity for 8 times. Yeah, there's a lot of equity to be, a lot of money to be made and a lot of equity you could build upon. So,
and the company can be debt free by the time, obviously, you sell it as well for, 5,
exactly.
6 million of EBITDA. Now, let's talk about the rising interest rates and how it's affecting the M&A activity. First on the acquisition initial side, and then obviously on the exit side with PE buyers on the other side. What are you seeing out there?
So what we've seen with the rise in interest rates is like the biggest impact on interest rates has been on the bigger deals because those deals were done with less equity. In a good market, those deals were being done by less equity. When interest rates go up, obviously, it makes it harder to do it with less equity. The interest rates really, I would say, put almost a dry spell on what I would call larger deals, upper middle market deals. But interestingly enough, the interest rates didn't change that much in the lower middle market or the middle market because in those deals, people were always putting a lot of equity up. They weren't putting minimal amount of equity. And so, you look at these search fund deals, people were always putting a certain amount of equity in. And remember, when we talk about an equity, we're looking at it from the point of what the rollover is and the equity put in and the promissory notes. Like, it was always, the bank was only funding ever 40%, 50%, maybe a little more than 50, but it wasn't doing 80.
There's a lot of cushion in there.
Right? There was a lot of cushion, right? And so, maybe, I found in 23, the bank kind of asked for a little bit more equity, but it wasn't dramatic. And so what it meant in these type of deals was, well, first of all, the multiples were lower, so it made it easier to get the deal done. They were putting more equity in. So even if the interest rates went up, it didn't really change the modeling for the kind of return profile on these deals. Like, it still worked to do these deals. These deals kept going. Like, we really didn't slow down in the middle market and the lower middle market. But again, it was because people just put more equity in. And given the nature of these deals and the way they worked, it was just not as risky as some of the larger deals where you had less equity and just the debt played a bigger role in the success of the deal.
It's interesting. I wonder if some of the founders or sort of the acquirers of these assets is, $1 to $2 million EBITDA businesses actually started to get more interest from sellers trying to sell them assets who were hoping maybe that a private equity firm would come in. And then they can maybe gobble up a few more of these smaller, synergistic assets. And then when the market is starting to recover, the companies go out back to the M&A market and see what's happening.
Well, I would say to you that from my core practice is, U.S. Canadian private equity in the middle market, and then also the search fund. So I do a lot of work for Canadian, U.S. mid-market private equity funds. And what they did in towards the end of 22, 23, and now 24, bolt on. bolt-on, because you could do it off the balance sheet, right? They were exactly to your point. But even those, you said it right. We had less buyers in the marketplace, which is probably some of the reason why the searchers had a good couple of years, because frankly, a lot of the strategics went to the sideline. A lot of the private equity firms went to the sideline. People just, they were very conscious about using capital and kind of very conservative. Now they're starting to open up now. We're really seeing people are feeling interest rate change coming, and it is. And frankly, I think people now, I mean, the one thing about private equity is at some point you got to get off your butt. You got to allocate. you got to do deals. You're paid to do deals. And if you don't do deals, you don't get paid. So I think we're also seeing some of that. But I think the search funds and what I would say the kind of lower middle market funds that kind of focused on bolt-ons had a good run in 22, 23. They weren't, whatever the word, sexy deals. You know what I mean? They weren't the high, but they got a lot of stuff done, because the other thing about the lower middle market, Matt, and the multiples are reasonable, right? So that didn't change. Like, unlike, the bigger deals in 21, 22, people were getting crazy multiples, which of course then that affects the whole debt structure and all. In this space, in the middle market, the lower middle market, I mean, a $2 million EBITDA business is going to sell for 5-ish. Like, it's always, it hasn't changed, right? Like, and if it changes by half a turn, maybe it's 5.5, but it ain't going to 7.
But Mary, I got to ask you a question, because a lot of these $1 to $2 million EBITDA businesses are often run as lifestyle businesses. So flipping sides to the sellers here for a second, what common pitfalls are you seeing happening from the seller's perspective when it comes to the due diligence process? And can you share any memorable due diligence challenges or stories that you encounter, without naming names, that people should be made aware of?
Well, look, and let's talk it from a buyer and a seller's point of view, right? The biggest risk for buyers of middle market companies is not being able to sell them when you want to sell them. And I can tell you, the last few years, I've had people show me all kinds of deals that they can buy cheap. Oh, I found this, retail furniture business that's doing well, and it's really, I can buy it for 2 times. And you kind of have to tell them, look, you could buy it for 2 times. And you know what? It might be a great cash flow business, but you're never going to sell that. There's no buyer for that business. One of the things that I think people mistake, well, first from the buy side, but then we'll go to the sell side, is like, is this business even sellable? Right? And people sometimes underestimate the complexity in selling a business and what a buyer is looking for. And so one of the big challenges we have in the middle market is, especially with the search funds, is people find a business and they really like it and they can get it for a really good price. But when you look at the fundamentals of that, but there's no buyers for it.
There's a reason you're getting it for such a good deal.
Maybe you own it and you just focus on cash flow, right? But,
Yep.
You're not going to sell it. Or frankly, you're not going to sell it for any kind of a multiple uplift, which of course, that's the goal, right? Buy a business at 4 or 5 times, sell it for 8 times. And so that is, and then of course, the challenge of the sell side is you get these owner operators who just assume that their business has a market for it. And they don't realize that at the end of the day, the people you have in front of you might be the only people who buy it. And so they ask crazy multiples, and they just, their perception of what their business is. And I understand why. They've been sucking 2-3 million out of it every year. They're like, this is fantastic, right? And then you tell them, yeah, but no one wants to buy that business, because at the end of the day, what are you going to do with it when you buy it? So that's one thing. The other thing is, obviously, look, they're owner operated businesses, there's all kinds of stuff going on in their balance sheets we get it. They're entrepreneurs. They got some personal expenses. They got lifestyle expenses. They put, a lot of sellers of lower middle market companies don't appreciate the amount of work you need to do to get ready to buy a business. And so they're messy, and that's the opportunity often for buyers. And I would say, what I would say from a seller point of view is, even if you are a smaller company and you want to go for sale, you should put a bow on yourself. Make yourself look right for a sale. Do the seller diligence work required to make the company look good for a deal. And then, on the buy side, the challenge, of course, is you're buying messy companies, and you have to sometimes just live with it. The thesis sometimes is, I'm going to work through all this messiness because I can see where the opportunities go. That's a challenge, but that's some of the best deals that we've had in terms of multiples and all. We're buying a business that had a lot of issues with it, but you can get your head around it. You buy it cheap. It's got some good fundamentals. Its core thesis is one where you could grow, and you could see buyers on the other side who are going to take it off you if you get it to the right place. But it's messy, right? There is no perfect 2 or 3 million EBITDA business. That's what you're buying. That's the opportunity. Frankly, there's probably no perfect business anywhere, but in the middle market and the lower middle market, like it is something that the smart buyer figures out the opportunity and is willing to do some of the cleanup work, And keep in mind, Matt, like I get people sometimes say, this business doesn't have an ERP system. It doesn't have any sales. It doesn't have the staff that it needs. And you're like, dude, that's the opportunity. That's exactly it. That's what you want, right? Because you're going to bring all that professionalism in, You know what I mean, Matt? And that's like, you're right. It doesn't have all that stuff, but that's the opportunity. Your value add, as soon as you get there, is to bring that professionalism to the business that's going to lead it to a whole other place.
Yeah. I mean, especially during COVID, Mario, we saw a lot of like tech entrepreneurs or operators saying, hey, I can go buy an online e-commerce business. There was so many like secondary marketplaces popping up for buying these businesses because people were just like putting their, EBITDA on the website and be like, yeah, I'd buy that, for one times EBITDA. That sounds great. And I can throw some CRM and a new website up and some new messaging and SEO, and I'm off to the races. It's not that easy though. But, you mentioned something about the sellers and getting prepared for that M&A. What advice would you have again for the sellers in terms of one, timing? Because everyone knows you got to normalize your EBITDA for the last 3 years or more. No one's going to judge you on your most recent, financials. How much time do they need? And what advice would you give them on preparing for an M&A if they were on the sell side and they came to you?
I would say first thing is, if you're going to sell your company, you need 2 or 3 years to get ready for it. Not months. People think it's months, it's years. And the second is, and look, this is a self-serving comment. Take it for what it's worth. Owner-operators don't want to spend money on advisors. I get it. I've been there. I've seen it 100 times over. But as long as you understand, the money you save on the advisors is going to affect the ultimate purchase price at the end of your deal. And this is where there's a disconnect, right? I'm like, dude, you want to spend money? No problem. Don't spend money. But when it's messy and we get into a sale and you could have spent a couple $100,000 to clean it up and put the bow on and get it right, fix all the issues you had. You can't fix it in the middle of a process. There's no amount of money you give an advisor when a buyer has discovered the warts in your business. You would have saved way more earlier to fix it. And your purchase price will be more dramatically affected by the fact you didn't fix it than whatever you would have paid. And you know what? I'm saying that to you. And I work with a lot of owners. Another side of my business is work with a lot of sellers. Because I do a lot of private equity, I help sellers sell to private equity. And I say that to sellers, and I'm saying this to you knowing they're not going to listen. I'm saying it to you, it's just the way it is. Particularly in the kind of lower middle market, an owner-operator, as soon as you tell them to spend money to professionalize their business or get it ready for a sale, looks at you as though they think you're just trying to take their money. And sadly, I do my job. I tell them. But it's the biggest mistake that they make is that they assume that their business will sell no matter what. And worse than that is that everybody thinks their business doesn't have problems. And, again, we talked earlier, there's always issues. And the sad part is, if you could have gone there earlier, you could have probably put a spin on it, fixed it, made it a non-material issue. But you can't do anything about it. It is what it is. I would just say one more thing is, people do tax planning on a sale too late. And again, start early. Like, it just comes back to start early. Like, if you don't want to spend money on good tax advisors to try to maximize your sale proceeds, you're just at that point ready to lose money. And that's what I say to owner. I always say this to owner. I don't really mind if you don't want to spend, but don't come to me. As long as we're okay. And then I find they kind of start thinking, well, man, this guy's being defensive about it. Because I'm like, if you lose millions, don't come to me later. I told you I did my job. I go to sleep at night. I'm happy. And then, because I actually find if you say that, say, look, I'm just doing my job. I've told you now. You heard it from me. You won't listen. And then they kind of go, wait a minute, should I believe it? That's what because I find if you actually just say to them, you should do this, they think you're just trying to take money out of their pocket. And it breaks my heart.
No, it's really good advice, Mario. It is great advice. The tax planning side, even before sale completes, as well as the preparation 2 or 3 years ahead of time, is really, really good advice. But I want to put your psychologist hat on for a second, okay? Put yourself in the entrepreneur's shoes. They just closed the transaction. They show up to work the first day as the new CEO of the company, and they've got a bunch of employees who've been with the company for a while to meet with and deal with and share the news. What advice would you give them from a cultural perspective to try to keep things moving in a great direction while also picking up momentum that a lot of people who just come from it from a transactional point of view may not be aware of?
I would say to you that what we've learned, at least from the searchers particularly, and I've learned this from private equity as well, one of the key elements of success for these deals is the relationship of the searcher, the buyer, with the seller. And I'm not talking about professional relationship. I'm talking about personal relationship. I'm talking about getting beyond just the high-level deal terms. I'm talking about building a real relationship. I find sometimes buyers underestimate the knowledge that sellers have, not just about their business, but about the space, the market, the opportunities, the growth stories. Sellers, look, there's a reason why they're super successful, man. They grew these businesses from nothing. And people sometimes underestimate the knowledge that they have because they think, I'm a professional, he's an owner-operator. Yeah, but if you drill down with that owner-operator, he'll tell you your targets. He'll tell you your natural opportunities to grow. They often know exactly where the business should go. They just don't want to spend the money to get there. They're just not the type of people to kind of take that risk. And, when you get to know an owner-operator and you get to know their staff, and then to your point about coming to work, people don't appreciate that. Again, there's a ton of knowledge in their staff in a model of an owner-operator where he's really focused on saving every single dollar. They don't have the freedom to focus on growth. They don't have the freedom to think outside the box. Their owner doesn't want them to. Dude, I just want you to do this. I am not focused on spending money to grow, right? I just want to focus. So, there's an untapped potential of staff following closing, management, key people. A lot of these companies, they don't even have really a sophisticated sales operation. And, they might have people who are kind of almost half-time sales or like just doing, and you all of a sudden free them to say, listen, I want you to give me what you think we should be doing. And so I would say to you, one of the key things for a new CEO to come in is listen. Just sit down and listen and just really listen to the staff, listen to the management, listen to the owner. Like just listen, really do a deep dive of listening. And it's unbelievable talent that's there. Because you got to remember, this owner created something special. It wasn't just one person. There's a lot of reasons why you're buying this company. It's not just in the owner. It's the people around it's the secret sauce. And so people sometimes come in and forget that, and they lose out on the opportunity to maximize the human potential of the people that are there.
Mm-hmm. And keeping them incentivized by having them on as consultants or a 10% rollover, structural things that you help with to keep them aligned and to keep sharing all that good knowledge is super important for the first few years of transition.
People got to remember that a lot of the buyers that we work with, they want to enter into these companies, and the mind shift is almost immediate. Their focus is immediately on growth. And they don't realize they have to tell the employees that. Like we are in a different mind shift now. You see this often where you hear, I hear it from the searchers, but they'll say, like, employees feel liberated. You mean we can start thinking about growth? Like, you mean I can spend money to grow?
Yeah.
And so they end up having all these ideas, this pent up entrepreneurial spirit. Like, this is kind of like, are you telling me I can focus on, like, yeah, you could spend money to grow. And you'd be amazed how much talent and opportunity and good ideas are there. And so I would just say to people, listen, because there's a lot there you can work with.
Mario, this is a technology-focused podcast. So what role do you see technology playing in evolving this M&A space we're seeing here in Canada? And what other opportunities are you seeing for the young entrepreneurs who want to bring the mix of that growth mindset and technology into the M&A space? And
if I could take a step back, like if we look at tech M&A in our marketplace, particularly in the lower middle market. So, it used to be that searchers used to do, and you probably remember this yourself, there was a time in our marketplace when kind of big tech was focused on everything above 10 million ARR. And we had a ton of these kind of smaller deals in our marketplace. And the only buyer maybe was Constellation or Banyan or Constellation-like, I'll call them. And they were buying them pretty cheap. But the marketplace has evolved. It's changed now. So that, you know this better than I do. Matt, you take a decent 3 million ARR business that's got decent cash flow and growing 10, 15%. And people are snatching at it like it's crazy. The multiples of even for that business now have grown almost exponentially, right? That is the new growth opportunity, right? People have come downstream. And so it's made it harder to buy tech companies because there's so many people looking even for smaller tech companies. Well, what does that mean for people who like tech? Well, it's what we're starting to see is people will say, well, wait a minute. I won't necessarily look for a tech company, but to your point, I want to do that tech. So I'm seeing a lot of buyers who say, you know these words, the tech-enabled kind of words. And in fairness, I've seen some of the success the tech-enabled brings. I mean, I'm not a tech guy. And it's fascinating when you see people say, well, wait a minute, I got this distribution business. It's about as old school as it gets, right? Inventory-driven distribution business. But guess what? You get somebody who's got a tech perspective on it, and all of a sudden they add layers of value by just the tech that they bring to it. And if I would say to you where I think we're going in our marketplace for tech investors is, hey, you tell me if I'm wrong, and I mean this for the lower middle market, because I think it's already happened for bigger companies. So obviously, that's a whole different beast. Is whereas it's getting harder and harder to buy classic SaaS, business with the ARR of 3 million. Those deals are, I don't know, you see, man, 4, 5, 6 times. Like they're getting the multiples on those deals are just increasing. People are saying, well, wait a minute, maybe I could take old school manufacturing, distribution, business services, and bring new school tech to it and really almost make it a tech business. And the interesting part, we're not talking about a 10 million EBITDA business. We're seeing people buy a million or 2 million EBITDA business and then unleash potential by bringing tech to it. And that's, I'm seeing a lot more of people who like tech who actually aren't doing tech deals per se, but doing deals that have the smell of something you could really add value with tech. And that's becoming super popular right now. I don't know what you're seeing, but that I would say in the tech space is what we're seeing a lot of.
Two things to add. One is that there is a tech-enabled, off-the-shelf software tools that are being applied to legacy industries and legacy businesses that are allowing them to free up human capital to do services with software. So you think about customer service, call agents, accounting, inventory management, ordering, all those things that were typically done by, salaried employees are now being able to be augmented with software, which allows these 1 million, 2 million EBITDA businesses to free up more margin and more resources. That's one thing that we're seeing. It's really exciting. The other thing that we're seeing is actually technology solutions being applied to legacy industry problems. And some of those companies thinking about actually buying those underlying companies to buy the revenue for one times because they're struggling. And some of them are like break-even businesses. And those people have no exits in place because they're just fledgling businesses. But the customer base they have is super valuable. And some of our software-powered businesses can, in day one, take that revenue and make it an 80% gross margin business. And that's really interesting.
Now, other thing I'll add in the tech M&A space, at least in Canada, your thoughts, Matt, too, is we're starting to see more what I call mini aggregators. People who want to buy tech businesses and they're coming downstream and they're willing to buy. It's crazy. Years ago, no one would buy a 1 million ARR business. People said it's too small. No one would buy a 2 million. But now we're starting to see people willing to say, I'm willing to buy them and then put them as a part of like almost a portfolio and build out, whatever you want to call it, the next mini Constellation, mini Banyans, it's becoming, and I'm seeing people out of nowhere come to me and they kind of got the searcher mentality, right? Their idea is I want to buy deals, but they want to really aggregate them. And their idea is if I buy 5 or 6 I can see where they're going. All of a sudden I kind of look like I have 10 or 15 million of ARR because I bought 2 times 6 or whatever, 2 times 8. And so it's super interesting. Like that's a whole new, I've done a bunch of those deals recently, and tech M&A seems to be, at least with what I call the real lower middle market, really have developed a new suite of these kind of mini, I don't know what to call them, Matt. You know better. Mini aggregators?
Tiny Capital has been trying to do that. Mini aggregators, Constellation Cubs.
That's interesting for our market, which, in the old days, you couldn't find people who would spend very much for a 1 million ARR. They would say it's just too small. Not anymore. Now you got even these aggregators doing these kind of small tech deals.
Mario, you obviously deal with a lot of high stakes M&A negotiations that could often fall apart at the very last moment after spending 3 months going through negotiations and due diligence and back and forth and high cost. How do you manage those complex situations and high pressure situations? And what advice would you have for some of the buyers out there that are also going through that?
Well, and it's really difficult because you spent months on a deal, months, sometimes 5-6 months. Your spend, after 5-6 months is incredible on the fees, whether it's lawyers and accountants and advisors, and then you have a worn out seller who, of course, is their advice. It's really hard in those moments when a deal starts to go sideways. And look, what I would say is, and I think it's underappreciated, most deal problems can be solved. I've seen very few that are insurmountable. Obviously, if a business isn't what you thought it was when you bought it 5 months later, you can't do the deal. When deals start to go sideways late in the negotiations, there is a responsibility, I think, as an advisor to almost double and triple check to ensure that the reason why this deal is sideways is because of miscommunication, misunderstanding. You wouldn't believe the amount of sometimes the dynamics, Matt, where people just get it wrong and I thought he was saying or she was saying. One of the things that I think we have to be conscious of as advisors is when people spend that much time on a deal, they want to close. People say to me, Mario, they don't want to close. People don't spend 5 or 6 months on a deal and some issue comes up and you think that that's an issue not to close. I just think it's important in those circumstances to highlight not only the issue, but the relationship dynamics, because often that's what's really broken down.
Fantastic advice, Mary. Before we wrap things up, we always ask our guests for their fast favorites. So first off, your favorite podcast. Yeah, you can plug your own podcast here. Come on.
Oh, man, it's a great. I actually like your podcast. I actually do like your podcast, and I'm not saying that. I mean, if you want, but I actually do like it.
I love your podcast too. I love the guests. Tell us your podcast name and what it's about.
All right, my podcast is called Views from the Market. It's a podcast focused on mid-market private equity in Canada, and it really tries to get mid-market participants. So it's not meant to go after the super big brands. It's meant to get what I call the real warriors of the mid-market. The sell-side advisors who are out there every day, the buyers out there every day, the real mid-market participants. So I'm really proud of that part of it. We are talking to the people who are doing the 2 million EBITDA sale, 3 million EBITDA, 4 million, 5 million EBITDA. We're not talking to people who are doing 500 million EBITDA. Nope, that's not what it's about. And it's short. It's 20 minutes an episode. I've done about 115 of them. And if you're interested in the middle market and some of the topics we talked about, I recommend it. Like I said, we've had a lot of good sell-side advisors, a lot of good buyers, a lot of good sellers on it, and they really talk about their experience in the middle market.
And it's a great community, too, of people that the future buyers can lean on that you've obviously brought together.
I mean, some of the searcher stories are incredible on the podcast. So, you people who had no money, bought a company and turned it into an unbelievable amount of success.
Absolutely. Well, next is your favorite newsletter or blog?
New York. I'm a New York Times lover. Everything New York Times. So I spend way too much time on the New York Times. Way too much time. Way too much time.
Favorite tech gadget?
You know what? It's my AirPods 2, which sounds weird, but my AirPods 2. I use these things all day long. I don't know why I love them. And I've actually tried different ones. So it's not like I'm an amateur telling you. I've tried 4 or 5 different ones. AirPods 2.
Nice. Favorite new trend?
I love the way TikTok has a reflective effect back on us. So I actually have become a big fan of TikTok because I've seen the impact it's had on my kids. And so I've kind of wanted to be engaged by it. And what I mean by reflective is people don't just watch TikTok, but then it becomes cultural norm. What comes out of TikTok becomes part of everyday conversation. And people say, where'd you get it from? TikTok. I find it fascinating, man. So I've become a big TikTok watcher, and I've kind of seen it now for myself where I'll say, I got it from TikTok. It's so cool because it's a whole other world that we didn't have when I was growing up. So I'm fascinated.
Favorite book?
English Patient. So it was a nonfiction English Patient. One more. Kafka.
And last but not least, your favorite life lesson?
I'm all in what I do, and if you're not all in, you can't expect the results if you got to be all in. If you want it, you got to go for it. You got to be all in.
Fantastic. All in. Fantastic advice from partner at Stikeman Elliott, Mario Nigro.
Thank you.
Hey everyone, thanks for tuning in to another episode of Tank Talks. We hope you found today's conversation as insightful as we did. If you're enjoying the show, we've got 3 quick things to ask of you. First, hit that subscribe button on your favorite podcast platform so you never miss an episode, whether that's Apple Podcasts, Spotify, Google Podcasts, or YouTube. Next, follow us and stay up to date on upcoming episodes and behind-the-scenes content on social media with Twitter, LinkedIn, and Instagram. And lastly, share the love. If you found value in today's episode, share with a friend or colleague who'd benefit too. Your support helps us bring in more amazing guests and keeps the Tank Talks engine running. That's it for today. Until next time, keep disrupting and innovating.